so here's a typical example of how we calculate the RSP contribution rule for that particular year. Remember that I said that the formula was 18% of your earned income your previous year to a maximum of whatever, okay? So let's say that in 2016, your income was $50,000, okay, from all the sources of earned income. You all add up, let's say $50,000. So 18% of $50,000 is $9,000. So there's your limit right there. So even though in 2016 it was roughly about $24,000 you could actually contribute, because of the 18% rule, you can't put in $24,000. The maximum you can put in is $9,000. However, at the same time, that previous year, in other words, in 2016, you had $2,000. In other words, you were a member of a pension plan and everything, and you were you contributed to that. Your employer contributed to that. So therefore, you have pension adjustment, PA, pension adjustment, $2,000. Also, your employer said, this is a brand new pension plan. You've worked for me all these years. You've never had a pension plan in the past. I will let you contribute on your behalf for past services. So the past service pension adjustment for the current year, in other words, is also $2,000. Okay, so all these numbers are all given to you when you actually do the math and everything else. Okay, and now, so therefore, the contribution. Remember, we started off with the maximum contribution level of $9,000. All of a sudden, we're down to $5,000. Why? Because you already have $4,000 that you've already contributed through your company pension plan. So you still have that $9,000 of deferred money and everything else, and in tax deduction and everything else, except that you writing a check to your financial institution cannot be more than $5,000 in this particular case. At the end of the day, however, you haven't been contributing very much to your RRSP since you were 18. You've been working and so on and so forth, but you contribute a little bit, maybe hodgepodge, but never really contributed the maximum. So therefore, you've got lots and lots of contribution room that you can carry forward the same thing in the future. So one day you wake up one morning, you say, well, I think it's time for me to catch up with all this. I've had a good year, whatever it is. And let's say you've got $15,000 in carry forward that you haven't used in all these years and everything. That carry forward then can be added. So there's your plus. So now you can actually write a check for $20,000 and basically catch up on everything, okay? And remember also you have a one-time over contribution that you can also add in there of $2,000. So basically in this example here, you can put in $22,000 and catch up on everything, just essentially. Any amounts of money you put in over and above that $20,000 will be subject, set to a penalty of 1% per month, so 12% a year. So you've got to be very careful when you do this kind of calculation to make sure you stay within the line. Okay. Now the good news, of course, in all of this is that Ottawa does give you that information that you need to calculate your contribution level and everything. Okay. And going back to this carry forward for a moment, remember that even upon death, okay, when a person dies, it is quite possible to catch up on that carry forward as well at the year of death. Okay, you can catch up. In other words, you can catch up anytime, whether you live or die, whatever it is, you can catch up anytime. However, at age 71, if you have not caught up with all this, when you do turn age 71, the year you turn age 71, basically that is lost. That is lost, and so therefore you got to be very careful because you may end up getting to age 71. You've had all this contribution room and everything else, and it just being basically wasted, you might say, because you couldn't use it. Okay, so that's the issue that you have to look at. Now, at age 71, of course, you have to annuitize that money, and so therefore it's subject to what we're talking about very shortly. So all the way through, basically, it's a deferred annuity, and then at age 71 or earlier, you can take all that lump sum amount of money and basically roll it into an annuity that will give you an income for whatever period of time. So in other words, a registered retirement income fund or life annuity, things of that nature there. Okay. But what if throughout that period of time, you've been accumulating money and everything else. Now you want to use some of that money for immediate expenses. The moment you withdraw any amounts of money whatsoever out of an RSP, okay, in that fund, okay, it will be taxed. It will be taxed at your highest marginal tax rate, whatever rate happened to be that particular year. Okay, and so therefore you got to be very careful that if you remove monies from an RSP, remember that it's because it's registered money, the adjusted cost base is automatically zero. Remember, you took a deduction. The moment you take a deduction, the ACB becomes zero. So that means that every dime is taxable in here. So if you take out $5,000, the entire $5,000 will be taxed at your marginal tax rate. Okay, so you've got to be very careful of that. There are two exceptions to that. The first one is the what we call a home buyer's plan, first-time home buyer's plan. You can take up to $25,000. Okay, you can take up to $25,000 from your RSP basically make a withdrawal. I said to you that the moment you make a withdrawal, you've got a tax issue. Simple as that. There's withholding tax, there's taxation, there's all that because the ACB is zero, so you will be taxed. So now we're saying is how can we? Is there a way I can get around that? The answer is yes. If you are a new home buyer, in other words, you've not been own a home for at least 4 years, okay, you are technically a new home buyer. You can in fact withdraw $25,000 from your RSP and not incur any taxation at that. So basically, it's just simply a withdrawal. There's no tax involved whatsoever. However, the money must be used, obviously, to buy a home or a condo or whatever it is that you want. But it must be used for a residential, not for business. It has to be for residential purposes. In which case, then you don't have to worry about paying any tax on that. However, the money does have to be paid back over a period of 15 years. So basically, you take a $25,000 divided by 15, basically whatever that number is, then that money, you have to pay that on a yearly basis. You can pay the whole thing off if you wish at any time you want, okay? But you must at least make your minimum payment every single year. If you fail to make a payment that particular year, let's say it was, I believe it's around $1,600 or $1,700 a month, let's say, a year rather, if you fail to make that contribution that was paid back, then that particular year that you did not pay it back will be considered income for that year. So you will receive a reassessment on your tax forms and everything else. So if you fail to make the payment, you will in fact be reassessed and therefore have to pay tax on the money that you did not pay in that particular year. Okay. Also, should you die along the way and you still owe, let's say, $10,000 on this, you haven't paid back $10,000, that gets caught up in the year of death as well. And so therefore that $10,000 becomes income at the year of death. So it's very important that you make your payments, that you pay these. Otherwise, you will incur taxes on the portions that you did not pay. So you missed that year, or you died, and there was still outstanding balance of the loan, you might say. You got a tax issue right off the bat. Okay. The second thing that you can use for RSP money, other than for retirement purposes, of course, is what they call lifelong learning. And this is basically for people that want to go back to school. And generally speaking, these people would be mature students, whatever. They may not necessarily qualify for any kind of financial assistance like OSAP or anything along that line, but they have an RSP. And they now wish to go back to university, college, whatever, to rehabilitate himself, get a new career, whatever the case may be. But they don't have the money, they don't have the tuition fees and everything else. You could, in fact, again, withdraw up to $10,000 from your RSP and be able to pay your tuition fees and so on. Okay, so generally, it is you might say for a 4-year degree program, you can borrow, let's say, up to $10,000 from your RRSP. Again, as long as you're using it for that, for the education purposes, once again, you'll be tax-free at the time of withdrawal. But once again, you do have to pay it back. Okay, you do have to pay it back, and you've got to pay it back over the length of 10 years, certainly. And usually they'll give you a couple of years after you graduate to establish yourself, and then payments have to start. So the same thing, if you don't pay it back, then that'll be considered earned income. That particular, so therefore it will be taxable at that point. And once again, should you die and the balance is still outstanding, once again that will be considered income for that particular year. And so therefore you will have to pay tax as well. But these are the two sort of non-RSP, non-pension users, you might say, of RSP money, first-time home buyers and lifelong learning. Anything else you take the money out for will be subject to withholding tax. It will be subject to taxation and so on and so forth. Okay, so it is really designed to provide you with an income for your retirement. And so you start abusing it, you start using that money for whatever purpose you want, you will have a tax issue. Of course, if you cancel the entire package, so you've got $400,000, let's say, sitting in there, and you decide that's it, I'm out of here, I want to cancel the whole thing, then of course the whole thing is taxed at your marginal rate that particular year, so it'd be quite severe. So we certainly don't recommend that you do that kind of thing as well. So this is basically a quick summary, you might say, of your RSP uses.